Welcome to the Commercial Real Estate Show, your source for market intelligence, forecasts, and success strategies. Hello, I'm Michael Bull. Thanks for joining us on the radio, iTunes, YouTube, or the show website, commercialrealestateshow.com. Well, today we have an interesting show for you. We're going to talk about the Trump effect on the economy and on commercial real estate. Look, there could be a lot of changes. Who knows? I think everyone's trying to predict the future as you're making decisions for your business and for your real estate. What's going to happen? Well, we're going to have some experts we're going to talk to, and let's start by welcoming Victor Calanog. He's the Chief Economist and Senior VP with Reis. He's joining us on the phone. Victor, thanks for being with us.
Thanks for having me, Michael.
Well, Victor, let's start with corporate tax reductions and personal tax reductions. Is that really the easiest thing for a Republican House and Congress and Trump to do? What are the chances he'll do it, and what would be the impact?
I think that, as you noted at this point, number one, there are more questions than answers, and number two, execution really matters. So once he's inaugurated in a couple of days, I do think it's quite likely that the Trump administration and Republican majorities in the House and Senate are going to push to change the corporate tax structure and the current regulatory regime. So let's start with the tax structure. I know they've been outlined in very broad terms, but if you take a look at their stated intent on President-elect Trump's website, they aim to promote, quote-unquote, lower, simpler, fairer, and pro-growth tax structures, with initial figures from a lot of pundits suggesting large cuts in both personal and corporate income taxes. So, these changes are likely to benefit pro-business interests in the short run. I suspect that they contributed to the broad rise in U.S. equity markets immediately following the election in early November and cascading through till this week or just a few days ago. Things were up and down, but in general, equities appear to be anticipating a lot more economic activity from these tax cuts.
So commercial real estate loves job growth. So if corporate tax rates are reduced, what's that mean for jobs in the future?
Right. So, the question is whether tax reform will be implemented and how economic actors will respond. So, to your point, if individuals or corporations pay less in taxes, will they be spending more on productivity-enhancing investments, whether it's on the labor side, meaning will they hire more people, or on the capital side, will they sign those leases for commercial properties, tend to commit to 5 to 10 years of doing more business? Will these tax cuts stimulate increased economic growth that will offset any short-run decline in tax revenues? Because after all, you can't give money back without taking money from some other pocket. Mm-hmm. Will it support current federal spending obligations without increasing national debt and deficits to worrisome levels? So I think the worry about debt and deficits has been kind of put in the sidelines right now. A lot of people are anticipating more growth, hopefully more jobs. But it's kind of a double-edged sword. If things get a little too frothy, will you have lenders relaxing their lending standards again in competition with each other? So we'll see. It's really a tenuous balance that needs to be struck. And I think that political leanings aside, whoever was elected to office faces the same challenges, right? Just walking that tenuous balance between stimulating economic growth and avoiding a lot of the unintended consequences.
Right. And Victor, let's look at two property sectors in particular. So if you own or are investing in office properties, I guess when you look at the stock market and corporate tax rates being reduced, I guess you're kind of happy.
Yes, I think it's a net positive, and I know we're going to talk about this later, but if infrastructure spending is basically implemented at even a fraction of the $1 trillion original proposal, then it's going to vary by region, but by and large, it's going to benefit office properties, right?
Yeah.
Well, I think in general, that's going to be a net positive for office properties if implemented properly.
Yeah, I would hope so and would think so. And let's talk about retail. If we have personal tax rates are reduced and we're walking around with more money, I guess we're Americans, right? We're going to spend it.
We might already be. That's a good point, Michael. And I think we're already seeing it from the somewhat robust numbers that retail sales are pulling through for the holiday season. They're only now beginning to come through, but what's really heartening about it is that we don't seem to be sacrificing our personal savings rate, which is still hovering in the mid-fives, for increased retail spending. I do think, though, that a lot of the increased retail spending are happening in channels, whether online or through freestanding restaurants, that might not be directly benefiting retail real estate, right? So there's a lot of online spending that's going on. In general, that's great for the economy. That's going to work for a company like Amazon. I'm not sure that a lot of the big companies that have announced store closures are going to be pulling back on those plans because of this outlook.
Right. And we're talking with Victor Calanog, chief economist with Reis. So, Victor, let's talk about regulations. How about Dodd-Frank and how that's impacted commercial real estate? What do you expect moving forward?
Now, I think at some point in early November, Mr. Trump's transition team was quoted as stating they plan to, quote-unquote, dismantle Dodd-Frank, right? There were no further details provided since then, but I think what's clear is that the regulatory burden on the financial sector has really grown quite cumbersome since the end of the last recession, right? The question then becomes, what will replace Dodd-Frank? If it is truly dismantled, will the proper incentive structure be enforced to promote growth as well as protect against risks that really leveled us back in 2008 and 2009? And again, I'm going to return to that theme of that tenuous balance that needs to be struck. I don't think businesses resent regulation per se, but I do think that they resent cumbersome regulation that they don't see the point of. That doesn't necessarily make us feel safer, right? I mean, one question I like asking when I give speeches is, what more of a lift will a pro-business regulatory environment provide to commercial lending? If you take a look at the latest Mortgage Banking Association's figures, commercial and multifamily originations passed $500 billion in 2015. We've recovered levels last observed in 2007. So, we're back to peak. There's been some pullback this year, but I do think the CMBS lenders will be particularly happy if certain incentive structures that Dodd-Frank has promoted are changed. So, they pulled back. And it really depends on which lender type you are as to whether or not the new regulatory structure will work for you or not.
Right, but you're assuming it's good news for lenders if it's if there's some relief, right?
There's certainly latent demand for CRE loans. When you had CMBS lending pull back earlier in 2016, you had sources of financing like alternative mezzanine lenders stepping in relatively quickly, and that's how a well-functioning financial system and lending system should work, right? If some people pull back, well, there should be other players that should come in and see some opportunities there. Again, there's that tenuous balance that needs to be struck. Okay, should we encourage more lending? If we see better office property fundamentals, if we see more building because of infrastructure spending, well, that will require more CRE lending. The question then becomes, how do we encourage that without seeing LTVs begin to rise, without seeing DSCs become razor thin, and who's going to be looking over the lender's shoulder? It's not their fault necessarily. They're in competition to make sure that we avoid future crises.
Quick answer on, should we be worried about the 1031 exchange with the Trump presidency?
I think it's a safe bet that anything that is a tax policy that generally benefits real estate transactions will remain in place or will become better. I do think that it's a bit of a rhetorical question. I asked in one paper, will a U.S. president with a background in real estate be good for real estate? I suspect the answer to that is yes. Now, with that said, I mean, it's almost impossible to avoid unintended consequences. We're hearing anecdotal reports of transactions being postponed late last year in anticipation of a more favorable tax regime in the next 2 or 3 months, right? So there's a bit of a freeze in transactions because a lot of folks are expecting a better deal moving forward. I suspect that as a blanket answer in general, you should look to pro-business tax regime for real estate being more the norm.
Victor, thanks for joining us. Appreciate the insight.
Thank you for having me, Michael, as always.
Well, stay tuned. We'll have more on the Trump effect on the economy and commercial real estate. I'm Michael Bull. This is the Commercial Real Estate Show. Stay with us. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out creshow.com.